Hello, everybody. Good morning, good afternoon if you're in the US. Welcome to the final day of the Giants Conference. My name is Sam Wong. I'm a partner. I'm based in the Blackbird New Zealand office, and I'm really excited to be sharing the next half an hour with you and one of the best venture investors in the biz today, Sarah Tavel, partner at Benchmark. So usually we meet Sarah in San Francisco in the wonderful Benchmark offices.
Oh yeah,
and we do that as part of the StartMate trip, and Sarah very generously gives us her time then. But obviously, with lockdown and social distancing, we can't go to San Francisco, so instead we have brought Sarah to you. The theme of today's talk will be stories of great companies emerging from downturns. I'm going to start by just letting Sarah give a quick kind of potted history of her career to give you all some context, and then we're just going to jump straight into chat. I could probably talk all day to Sarah about her interesting journey, but this is not about me, this is about you guys. So please jump on Slido, sli.do, enter the event code Sarah to dump in your questions and upvote questions. Also, the chat icon to your right has the link pinned as well. And of course, you should definitely tweet your learnings to #Giants and make sure these nuggets get shared with the whole community. So without further ado, I will hand over to you, Sarah, to tell us quickly about how you got to where you are today.
Awesome. Well, good morning, all of you. I'm sure most of you have checked out my LinkedIn. Like the very quick is I'm actually a philosophy major, never thought I'd be in tech, landed at a venture firm called Bessemer Venture Partners out of college and spent 6 years there, making a bunch of investments across a bunch of different categories. The last one being Pinterest at the Series A, and then just loved the company so much. I ended up doing something that I now threaten to all the founders I work with. That I called Ben Silverman, the CEO of Pinterest, and basically asked for a job and joined Pinterest as a utility player. And we just had 20 or so employees, and became the first product manager there. And was there until we were 650 employees and had crossed 100 million monthly active users. And I led product for the discovery team there, so the search, recommendations, and a bunch of other teams, home feed. And then ended up hearing the call of venture, ended up deciding that was actually how I thought I'd have the most impact. And so joined Greylock as one of the GPs. And then got to know the Benchmark team and realized that this was the way I wanted to do venture. And so have been at Benchmark now for, I guess, 3 years. And is it 3 years basically today? Or 3 years in a week?
Flies.
Yeah, time flies. I'm on 5 boards, only one of them in the Bay Area, funny enough. 3 marketplaces, a SaaS company, and a consumer social company.
Awesome.
And we're like Series A, like 80% of the deals we do are Series A's.
And just for the benefit of everyone here, what do you call a Series A? Because we have what we call an Aussie New Zealand Series A and then the US Series A. So maybe
I'm not sure what you guys would call it. So, I mean, look, for a big percentage of the investments we make, we're actually the first check.
Okay.
And what we think of is that we always take a board seat, and we're buying, we're trying to own 20 to 25% of the company, and really be, shoulder to shoulder partner with the company. And so we're typically the first board seat. And so, and you could be a $5 million check or a $15 million check, anything in between.
Yeah. Okay, cool. Awesome. That's really helpful. So quite often what we see here is some angel rounds get raised at sort of like 1.5, 2 mil Australian, New Zealand, which is sort of like halve it now with the currency. And then, the Series A kind of gets done. At that 5 to 15 range.
We have the pre-seed, seed, and then the Series A at this point.
There you go, and I'm like, excellent. So I'd love to start at the beginning of your career, as you touched on. You started pre-GFC at Bessemer and sourced Pinterest. What was it that how did you discover Pinterest, and what was it about Pinterest that made you fall in love?
Well, it's, I'm trying to condense. I mean, for me, I actually had a random friend of mine who connected me to the founders of Pinterest before it was Pinterest. It was called Tote, and just kind of kept close with them. And then randomly, several months later, another friend of mine invited me to use Pinterest. And the first time I used it, I was just like, this is so, I had been thinking about user generated content and thinking about e-commerce and like the intersection of the two, and then got invited to Pinterest. And, Twitter was ascendant at the time. Everything on the web was just text-based, and Pinterest was totally fresh, totally different. And I just fell in love with the product from the first time I used it, and then saw that the team behind it was the team I'd met before. And so started to hound them down. And I actually was 2 weeks late for the seed. And then I just made sure I wasn't going to be late for the A.
So I'd love to kind of touch on that A round, because I think I've heard an anecdote that basically you guys were the only term sheet they received, but you sort of thought it was a really hyper competitive round. So I call that great fundraising kind of theater, I suppose, to be able to kind of convince you of that situation. What is some advice that you have for founders around how to kind of create that tension without kind of going to the direction of duplicity or being deceitful, I suppose?
Yeah, I mean, I think so much of it is about creating momentum in your process. And you don't, look, what I didn't realize, when I went into the meeting with Pinterest, like I just knew this was one that I wanted us to back. And I only found out we were the only term sheet actually at my going away party from Pinterest, then had a couple of drinks and then confessed all. And I realized that, like, part of it was just that we were kind of, once people are excited about the company, they're going to expect that other people are excited about the company too. And so in a way, there's just a virtuous cycle that happens. And that, it also, we did the process incredibly quickly because we thought it was competitive, and they moved the process very quickly because
they could feel your kind of urgency.
And so I think that there's definitely, like, you wanna be strategic about how you structure your raise, so that you're not just talking to one person in isolation, but you're talking to enough people that you're going to be able to create the dynamics that you want to create without being duplicitous, as you described.
Yeah, got it. And then kind of zooming out a little bit, obviously some great companies got built through that 09-10 era, so the Airbnbs and Uber, Twilio, etc. Pinterest, obviously one of them as well. What did you observe, I guess, about what those companies did during that time that enabled them to kind of ultimately be successful versus the ones maybe that didn't?
Well, those companies were all lucky because they were started after the financial crisis.
Crunch.
But but there are plenty that started before and thrived. And I had kind of two observations at the time, which is, number one, like, winning and losing during a time like this isn't about surviving. It's about having enough resources at the company so that when things start to thaw, and people have more comfort over their budgets, or consumers can spend money, whatever, regardless of the sector, that you have the resources you need to invest back and reaccelerate your growth. And the worst place to be is kind of feeling victorious because you've survived, your runway lasts, 2 years. But then, a year from now, when things start to really thaw and you can start to feel the acceleration in your business, you can't actually invest back in the business to grow. And so, some companies, I've advised them to, do the hard thing and make, some layoffs in order to be able to have the resources to invest back in the business a year or even 2 years from now, if that's what they need to do. And then related to that, it's the conversation that I saw happen to a lot of companies, and I see happening now, which is, don't have an ego about what the valuation is of your company, because the most important thing is having the resources to invest in your business and be able to accelerate the growth. And so if that means doing an extension of your last round, or taking, a round below what you thought you were going to take 3 months earlier, like, having an ego about that is the worst thing to block you from doing what's best for your business.
And do you think in the end, like, it makes up for it later on when you actually ultimately succeed?
Yeah. Again, like, when we're on the other side of this, which we will eventually be, that VCs, are going to have so many choices to invest, and
Yeah.
they're going to be, as they always are, leaning towards growth. And
Yeah.
so you need to be able to grow your business. Otherwise, what will happen is you'll end up in just a different category that gets harder and harder to
Yeah.
raise money for.
It's not good enough to kind of say, well, I was trying to conserve cash and that's why
Yeah.
my growth is 30%
Yeah,
year.
that's right.
Yeah.
That's right.
Yeah. Are you able to talk? I mean, you sort of talked about kind of the lack of ego around valuation. Are there other attributes that some of these, survivor founders have at this time that kind of come to mind?
Well, it's definitely the wartime CEO that you
Yeah.
hear a lot about. And as someone said to me, I love that there's it's not just enough to be a wartime CEO. Like, you have to know you're in the war in order to be a wartime CEO. And so I think that there's a little bit of being realistic and practical. And then it's a ruthless prioritization with your resources to make sure that you're using the resources that you have in the best possible way.
Yeah, that makes sense. So just kind of bringing it forward to right now, like a lot of founders, I think, are getting mixed signals around whether VCs are open for business. I mean, is Benchmark meeting new companies, and what's your general kind of perception of the market?
Yeah, I mean, and look, I promise this is not lip service. Like, we are aggressively looking at new companies, and we're doing that. There was rumored or announced that we're actually raising a new fund in order to be even more aggressive. Like, we believe fully that there's, the future is being pulled forward, that companies that may have once had, going digital on their 5-year roadmap, it's on like the 2-month roadmap right now. And so there's just so much opportunity for companies to take advantage of that, new startups to emerge, thinking from first principles of the opportunities that we have in front of us right now. And so, I actually got, I got within, it feels like feet of making a new investment that we only met virtually. So I have no question that we'll be able to do that, and that you can. It's harder. We can talk about what changes in the process.
Yeah.
But we're very much open for business. We're looking at a lot of new companies, and just really excited about the companies that we're seeing.
Well, let's just double click on the process part, because I mean, what do you think it does need to change to make it successful?
I think the way I think about it is that it's almost like if you think about in-person time as quality, and Zoom ends up being quantity. And so I've found that you just have to spend more time together. Talking, you can't whiteboard, you can't like have a dinner over drinks anymore. And so you have to have a little bit of this kind of less natural feeling of getting to know someone else while you're looking at a screen and you're kind of looking at the camera. It's just not the same. And so you have to put more time into it. The process just takes longer. And then I find that doing a lot of back channel references is a big part of it, because it's kind of you can't build the rapport as well over Zoom. So you try to use other means to do that. Yeah.
And so, I was on a call recently with a bunch of US VCs who sort of talked about how it'll be harder to back founders who don't come from sort of Silicon Valley central casting, where it's possible, I guess, to do that kind of referencing, 360 referencing around the founders. Do you think that's probably true, or how else, I guess, could founders from Australia and New Zealand who maybe don't have such great networks in the Valley kind of achieve the same result?
Yeah, I just don't think it's true. Look, like what the practical reality will be, in a funny way, I'm meeting with founders all the time, and they could be in San Francisco. I met with one company yesterday, and one of my partners asked me, like, where are they based? And I was like, oh, you know what? I don't actually know. Yeah. And so, it's funny. But look, at some point, we're going to be able to fly again, and we're going to want to meet in person. And so it's almost like you have this suspended reality for a little bit of where people are. But then eventually the reality will hit, which is that, are we talking about doing board meetings in Sydney or San Francisco? Like those types of things. But but I don't think, I don't, you know, whoever said that is getting, means that their stature is that they're getting more conservative, and we're the opposite right now.
Yeah, that's awesome. Okay, cool. So I would love to encourage more questions to come through on Slido. So hashtag Sarah and upvote as well. If you don't have a question on the mind, just upvote some other good questions instead. I might start with Stuart, your question around remote workforces. Would you be comfortable, I guess, investing in a company that's like completely remote? Do you have a preference even for that?
I was reading one of these comments, which is just not true, and I want to respond to it, but
okay, yeah, go for it.
No. Right. So the question is, have we ever invested in a company that's fully remote?
Yeah.
Yes. Yeah. There's not even that's not hard for us at all.
Yeah.
We have, you know, plenty of companies. I invested in one that, you know, actually when I invested, it was distributed, and it became a hybrid, centralized and distributed. But we have plenty of companies. Elastic is a more recent one that went public recently that's fully distributed. So we're very comfortable with that model.
Do you find that they have adjusted to this new environment faster or more easily than
yes.
non-remote? Yeah.
Yes. Yeah. I mean, I think everybody, yes, because, you know, it's a behavior. Being remote, being distributed, just, you know, is a behavior change, and it's an adjustment. And so if you've already been operating that way, then there's no adjustment. The adjustment's childcare. But beyond that, you know, it's been pretty seamless. And look, like, I'll admit, I still have a bias, you know, and I'm biased because I worked when I was operating, I was in a office, and I felt how easy it was to just, you know, kind of sit next to someone and get to talk to them. And so I do think that there are serious costs to distribute it. I do think it makes things slower because there's kind of more hold states, something that Ben Rubin said.
Yes.
But I, you know, there's a lot of advantages to it too, especially with, you know, resources like people being so expensive in the Bay Area.
Yeah, for sure. I'm going to just touch quickly and rephrase the question around valuations and, you know, a question around average raise amount and average valuations for Bay Area versus Australia and New Zealand. I'm guessing it sort of depends on the company, how much they need to raise. I think you touched on it before,
I have
like
no
5,
idea.
15.
Yeah.
Happy to kind of take that one off.
Yeah.
So Chris has posted around your kind of previous writing around virtuous cycles, and it seems really powerful. But do you have any good B2B examples, or could you talk to the B2B examples, and maybe for everyone else, kind of explain what you've written around virtuous cycles?
Yeah, I mean, I talk about virtuous loops, and the idea with virtuous loops is that when you're building a social company, you want to eventually get to a point where when users are using your product, they are helping to do two things, which is one, make your product better and better the more they use it. So you kind of, you know, if you're Pinterest, as more people pin, they give us more information that makes our interest graph deeper, which makes our discovery experience better. So that's one thing. And the second thing is that they help grow your product. And so an example of that is like all the growth stuff that growth hackers tend to do, where you connect to a new product and you want all your friends to be on that product too, and so you send them all a message saying, join me on whatever product it is. So you want to create those types of experiences where someone likes the experience so much that they want to share it, or there's easy mechanisms to share it. And on the B2B side, I would say there's certainly, especially so much of the products that are collaborative in nature or social in nature. And so any collaborative product, like let's take Airtable, which is, you know, one of Benchmark's investments. You could have an experience where it's just, you know, single player mode. And if it was just single player mode, it wouldn't have as much of the virtuous loops. But the fact that they create collaborative experiences and you end up, you know, working on a table, and then sharing it to some of your friends or some of your colleagues. And then they're, doing things with blocks to kind of get more data in, and it becomes this fabric that we're all working on together. That's a great example of a virtuous loop in a B2B context.
Makes sense. So it does seem to still be stuck on a more visibility rather than the single player use case, but it can be achieved in B2B. Excellent.
Yes, and very important to make it native to the experience. Like Evernote would be the other example, where Evernote tried to shoehorn collaborative experiences into it, but it was never really native to it, and so it didn't work. It didn't have a high attach rate. And so, they ended up not having that level of virtuous loops.
Got it. Excellent. What does Benchmark look for to invest at the seed round? What are some characteristics that you're looking for?
Well, we do the A, but look, so it's such a big question. There's so many things. We look for a founder that we really can believe in and back and go long term with that founder. Like there's never it wouldn't ever be authentic to invest in someone thinking, oh, we'll have to replace this person. Like we won't make those investments. So it's always about a founder who we think sees something that other people don't see, and has the ability to execute and the vision to execute. I think we bias very much towards companies that will create winner take most opportunities. We've never done a direct to consumer e-commerce brand, and struggled with a lot of other categories that feel more like they're kind of segmenting a landscape of possible customers, but not having winner take most dynamic. We're heavily biased towards network effects, of course. Even within software as a service products that we invest in, we look for those types of dynamics where you become the clear de facto leader, not one of a long list of options.
Do you think that means you're more likely to invest in companies that are vertical players versus horizontal players? I mean, Airtable's clearly not a vertical play; it's a horizontal one. But I mean, do you have any sort of biases one way or the other?
It really depends on what, it's hard to generalize because there's so many different categories. We love vertical SaaS. I mean, the SaaS company I mentioned is a vertical SaaS company called Chainalysis. We're on the boards of, a company called Benchling, which is like a super vertical SaaS application. We our thesis is that most people underestimate how big these companies can get. But, on the consumer side and the marketplace side, we actually bias towards companies are going after small opportunities because we think that it's really, really hard to try to make everybody happy, and that you have to really pick your battle and choose, that red hot center I always think of like, where's the need most bright and the fit with what you're offering, like the strongest, and then go strength to expand and potentially become horizontal over time. But you really want to nail a very specific use case and get that really right, at least for marketplaces, before thinking more horizontally. And that all the examples we've seen of people starting off horizontal on the marketplace side, it's just struggled.
And so what does the founder have to articulate to you so that they're thinking big enough, but starting narrow and focused on liquidity in the beginning in a niche?
I think it's absolutely just what you described, which is kind of, I think of great marketplace founders, and that's, honestly where I spend most of my time, as being just like incredible systems level thinkers and thinking through like each domino that they have to hit to get the next domino to fall. And I think a really great founder, what they articulate is exactly that, which is like, here's where we're focused. This is our red hot center. And then from here, though, we're starting to see kind of pull into these adjacent spaces and have a thesis that this is what the company's going to look like, 10 years from now, whatever it may be.
Got it. So I might generalize Phil's question, but I think it's a good one around sort of, you've invested in companies like sort of Recce, I think is one of your more recent ones, which is in hospitality. They've obviously, that industry has been hit really bad, and other industries like travel, like, I don't know if HipCamp is still open for business or has been able to, but these are obviously really challenging situations with COVID. How are you advising them?
Yeah, it was a rough few weeks, just going through. I mean, and look, I say that fully recognizing all the things that are true, the privilege and and it's been just a devastating time in our country and globally. But like what I've said, when the shock goes away is like, look, I get, you've spent I don't know how much time developing your 2020 plan. Well, through no fault of your own, you got to throw that plan out because all the assumptions that you had in your plan, they're no longer true. And all the, plans you had, the hiring plans, like you just have to let go of it. And we have we can't be beholden to any decisions we made in the past because we just don't know. We don't, for Recce, we just don't know when restaurants are going to be able to open up again. For HipCamp, we just don't know when the shelter in place is going to get lifted. And so how do we, you have to go into a wartime mode, which is that we can't pretend to make a 2020 plan now because a week from now, 2 weeks from now, we'll have such new data and learn so much. And so I think step number one was just to accept that this is not in our control right now. And then to understand what we can control, which are things like our burn and our runway, and then our strategy, our product roadmap, all those things, and what we focus on. And then just stay, heads down, focus on the long term, and you shall pass.
Is it a good time in some, and not specifically for these industries, but is there a case potentially in some marketplace businesses that it's a great time to sort of soak up supply more cheaply or to be creative, I suppose, about what is good about this situation?
No, absolutely. And there's plenty of examples. I mean, like that, and that's part of the other conversation we do have is once things have stabilized, then it's not like no company should be in a fetal position right now. Like you have to be taking, whatever opportunity, really finding where the bright spots are and seizing these moments, like it's very true. I've heard from so many companies, there's counterintuitive things happening where because people are staying home more, they actually have more time. And they're more willing to join webinars or they're eager to get on the phone or, for HipCamp's case, like you can imagine that, a lot of people want to make money now and they're thinking about how they can make more money. And so all these companies, like they need to, there's no dancing on graves, but take advantage of these moments and don't, and there could be an incredible time of growth if you position yourself in the right way.
I might take a more general question here, which is around companies that obviously you've observed through Greylock and Benchmark and Bessemer that get to the really big outcomes. What's the unifying trait amongst them all? Maybe trait of the company or trait of the founders potentially.
Oh, there's no besides luck. No, I mean, look, I think. I would say the biggest thing, if I'm being honest, is a wind in their sails. Like there's often some market dynamic that is a wind in your sails. And it's the classic saying that like a great team meets a bad market and the market reputation. And so I think that of the ones that you see that really thrive, like when you have a wind in your sails, you can make a lot more mistakes and still win. And so that would be, that's,
Is it very obvious to you when the market is helping the founder, with the pattern matching and
I mean, someone said this to me and I loved it. They said, execution times market pull equals results. And it's really, really good for founders also to recognize and be eyes wide open when market pull's really strong. It doesn't necessarily mean that they're executing really well, but and actually raise the bar on your own execution And I'm always paying attention to what's the balance between those two.
Yeah, fantastic. Well, I think we're on time. We want to be respectful and not go over. So I just want to thank you very much, Sarah, for making yourself available. Amazing insights. Everybody, please remember to tweet and hashtag Giants. And hopefully we will see you in person next time in San Francisco. And for everybody else, we have Zach Klein speaking next. So please join us. Yeah, he's doing this great talk on building the company you never sell. So enjoy that, everybody, and enjoy the rest of your day. Thank you again, Sarah.
Thanks, you guys. Stay